The next middle-class squeeze may not come from the mortgage rate, it may come from the insurance bill. For years, Americans were told the big housing problem was the home price, then the mortgage rate, then property taxes. All of that is true, but another line item has moved from boring paperwork to budget shock: homeowners insurance. And insurance is different from a luxury expense. You cannot simply decide to stop needing it. If you have a mortgage, your lender usually requires it. If you live in a riskier area, you may need it more. And if the price jumps, it hits the same monthly budget that already has food, utilities, car payments, credit cards, and the mortgage. That is why this is not just an insurance story. It is a middle-class story. Start with the scale. The U.S. Treasury's Federal Insurance Office released a major report using data from more than 330 insurers and over 246 million homeowners insurance policies from 2018 through 2022. The finding was blunt. Homeowners insurance is becoming more expensive and harder to get for millions of Americans. Average premiums per policy rose 8.7% faster than inflation over that period. And in the 20% of zip codes with the highest expected climate-related building losses, homeowners paid an average premium of $2,321. That was 82% more than homeowners in the lowest risk zip codes. That is the new map of affordability, not just where the homes are cheap, where the risk can still be insured. The private market is telling people something the real estate market did not fully price. A house is not just a house. It is a bundle of risks: wind, hail, wildfire, flood-adjacent risk, rebuilding cost, labor cost, litigation, fraud, local regulation, and insurer capital. When those risks get repriced, the owner gets the bill. That is why some families can do the math on a home price and still be wrong about affordability. The listing price may look possible. The mortgage rate may be painful, but manageable. Then the insurance quote arrives, and suddenly the monthly payment is no longer the monthly payment you imagined. The shock is not only that insurance went up, the shock is that insurance can decide whether the house works at all. LendingTree's 2026 State of Home Insurance Report makes the pressure easier to see. It found U.S. home insurance rates rose a cumulative 46.8% from 2020 to 2025. Colorado more than doubled, up 100.8%. Iowa rose 96.0%. Minnesota rose 88.2%. These are not tiny adjustments. These are budget-changing numbers. And the cruel part is that insurance inflation does not always feel like normal inflation. If eggs go up, people complain every week. If insurance renews once or twice a year, the shock arrives as a letter, an email, or an escrow adjustment. It feels sudden even if the risk has been building for years. That makes it perfect for a household cash flow crisis. Pew Research Center found that 71% of U.S. homeowners said their homeowners' insurance costs had gone up over the last few years. 42% said they had gone up a lot. That matters because it confirms the story is not only in reports. People feel it. And the burden is uneven. Pew also found lower-income homeowners were much more likely than upper-income homeowners to report having no homeowners insurance at all. 17% versus 2%. That is where the middle-class anxiety becomes sharper. Insurance is supposed to protect the asset that makes people feel secure. But if the protection becomes unaffordable, the asset becomes more fragile. Home ownership used to mean stability. Now, in some places, it means you are exposed to a bill you cannot fully control. This is also why the insurance crisis can quietly become a credit crisis. If a premium rises, the lender may adjust the escrow payment. The homeowner does not just see a separate insurance bill, they see the mortgage payment rise. That higher payment can strain the debt-to-income ratio, reduce savings, push other spending onto credit cards, and make refinancing harder. Dallas Fed Research has examined this link directly. It reported that insurance premiums nationally rose about 70% from 2019 to 2025 and studied how insurance became a larger share of monthly mortgage payments. This is the mechanism ordinary people understand instantly. Your house did not get bigger, your income did not jump, but the required payment went up anyway. Now add availability. Insurance is not only getting more expensive in some places, it is also getting harder to obtain. The GAO's 2026 report said homeowners in some areas have experienced reduced affordability and availability, and it examined private homeowners insurance data from 2019 to 2024, as well as insurer of last resort data. That phrase, insurer of last resort, is important. It means the normal market may not want the risk, so households are pushed into state-backed or special programs. Those programs can help people stay insured, but they are also a signal. Private insurers are stepping back from certain risks. When insurers step back, property values can eventually notice, because a home that is expensive to insure is a home that is harder to finance, harder to sell, and harder to hold. The mistake is to treat this as only a Florida or California problem. Yes, coastal storms and wildfires are obvious, but the data show the pressure has widened. Hail, wind, severe convective storms, rebuilding costs, and insurer models are reshaping premiums far beyond the coastal headlines. That is why states like Colorado, Iowa, and Minnesota show up in the rate data. The new insurance map does not perfectly match the old mental map of risk, and when risk models update faster than wages, the middle class loses ground. So, what should viewers take from this? First, when evaluating a house, do not look only at price and mortgage rate. Ask for realistic insurance quotes early, not at the end of the process. Second, watch escrow notices. A payment jump may not come from the bank changing your loan. It may come from insurance and taxes. Third, if you own in a high-risk area, do not assume last year's premium tells you next year's premium. The risk model can move faster than the neighborhood. Fourth, for investors, watch insurance as a housing market signal. If insurance becomes unaffordable or unavailable, it can pressure transaction volume, household credit, mortgage approvals, and eventually local home prices. The middle class is not being hit by one bill. It is being hit by the stack. Mortgage, insurance, property taxes, utilities, car insurance, food, credit cards. Each one can be explained. Each one can be justified, but the household pays them together. And that is why the insurance bill is so dangerous. It does not announce itself like a market crash. It arrives quietly, renews automatically, raises the escrow, and changes the affordability of the life people thought they already bought. Home ownership was supposed to be the safe part of the American dream. But if the insurance bill keeps rising, the dream does not disappear all at once. It gets repriced one renewal notice at a time.